Hello, good evening. Good evening to everyone.
Good evening.
Good evening.
It seems the class has delayed because I was waiting for your colleagues to join to the link, and it seems people are still complaining that they are not receiving the link. Is there an issue? Was there an issue joining?
Oh no.
But the rest said they are not finding the link. I don't know whether they joined late or something. They said they are having an issue joining. That's the problem. Anyway, I think we can start, eh? So one of you should just be watching the group. In case someone new joins, then you reshare the link. I hope that's okay. It will not slow the down. I hope that's okay.
Yeah.
Okay.
That's fine.
Shall we pray? Father, in the name of Jesus, we glorify your name. We thank you so much for another beautiful evening. Thank you so much for bringing us together as a family this day. Oh Lord, we pray for your divine protection. Come and take absolute control as we commit our lesson into your hands. In Jesus' name we pray with thanksgiving. Amen. Amen.
Amen. Amen.
Amen.
Okay. So you are all welcome to advanced taxation practice. Okay. And how this session works is that it's a practice session. We don't talk plenty. I will teach you what you need. Okay, this is the very first session, and I decided to make it open to everyone. We are going to look at the basis and everything we need about advanced taxation. And then we are going to dive into, so today we will cover a lot of material. So including the scope of income tax and how now CIT is going to be examining it in your current syllabus. I hope that is okay. So we are first going to start with the introduction to income tax and tax payable. Now, when you come to Ghana, Income tax is governed by the Income Tax Act, okay? 2015 Act 896, Act 896, okay? So if we say income tax is applied on something we call tax base, okay? So when we say tax base is something that we apply tax on. Do you understand? So when we say the scope of income tax, it means when we talk about scope, we are talking about the level of coverage. What does income tax cover? That is what we call what? So our 896 is what we use to Our at 896 is what we use to cover income taxes in Ghana. So if you know that act, you basically can easily pass the advanced taxation exam. So as the name implies, I get in it. It is a tax on income. There are three main types of income that are subject to tax in Ghana under the Income Tax Act. And these are business income, employment income, and investment income. And these are the main theme. This is the main theme of income. Okay, and this business, employment, and investment, especially business and investment, can apply to persons, different kinds of persons, but mostly employment is for an individual. Remember, an entity cannot have employment, right? It's an individual who has employment income. But when it comes to business and investment, when you're looking at types of persons, we are talking about individuals and entities. Only an entity that can have business and investment, but individual can have all three types of income, okay? So business income itself can be divided into sole proprietorship income tax, partnership income tax, company or corporation tax, and tax on income of body or persons or trust, okay? So these ranges of income can be on all these type of persons. And income tax is thus imposed on your total income, whether you are a resident person or you are a non-resident person. So if you want to understand taxation in Ghana, this is where you must start from. Know the kind of income tax, the kind of income you have, how the tax is applied, and on which person. So when you hear person in taxation, right? When you hear person in taxation can be categorized as an individual or an entity, right? So when you hear person, this is what we are talking about. But when we talk about entity, an entity could be a partnership, okay? It could be a company, it could be a trust, or it could be what we call an external company, which we now call permanent what? Establishment. So anytime you're doing tax and you hear person, these are the things we are definitely talking about. I hope that is okay. Put this in your mind. If you want to pass tax, these are the things that you have to focus on and you have to try to understand. Are we okay? So we are going to look at this in brief, as we go along in today's session. So we have seen what person is. So a person can be an individual, an entity, and I broke entity down for you, meaning that you must master the rules that govern these entities, okay? So I could say trust and other body of persons, right? Let me add this, because if I just end here, I've not been fair to the act, okay? So we have trust and other bodies of persons, and these bodies of persons is what you have: the clubs and societies, the building societies, the charities, right? They are all here. But mostly, the law defines these other entities as a company under Section 133 or Section 129 as well. Do you understand? So these are the rules that you have to understand, that we are going to tax someone on what? On his income, right? And that becomes his tax base. Okay, so I told you that the law that governs this income tax is the Income Tax Act. So why the Income Tax Act? Now, it was implemented on the 1st January 2016. I get it, but it was assented in September 2015. Now, why the Income Tax Act? It was created to revise and consolidate the laws relating to Income Tax Act. Now, before the Income Tax Act, the various income tax laws, were spread out. We used to have the Petroleum Income Tax Act on its own. Other acts on their own. Then we have the Internal Revenue Act, which only covered domestic tax revenue, meaning that petroleum and mining and those ones were not part, right? Other issues were not in there, but now all these ones have been consolidated into one, okay? And it has been revised. 2, to simplify the provisions of the act, that is true, some provisions have been simplified compared to the predecessor law. And 3, they wanted to make tax more user-friendly. And why is that so? Before, because of the revenue agencies, which were separate, I get in tax was not quite user-friendly because there were some bits and pieces of complexities. Are you getting it? Which we had to look at. And now, because of convenience and simplicity, the Income Tax Act was created. Okay, I hope that is okay. So before, something like dividend stripping and some complex issues were there, which people found a lot of problems around it. 4, to enhance efficiency and facilitate tax compliance. That was one of the themes of creating the Income Tax Act. To retain provisions that are particular or peculiar to income tax administration, broaden the tax base, remove the narrow and distorted tax base of the IRA 2000, the Internal Revenue Act. That was the old tax law before this Income Tax Act, and tackle erosion of the tax base, okay? And also help us align domestic tax rules with current international tax rules. So if you look at the main theme of the Income Tax Act, if you look at it well, we could say that there are general provisions, okay? If you look at the act, well, there are 3 things that the Income Tax Act covers. General provisions, realization, okay? So if you're a tax student and you don't learn realization, you haven't learned tax. Then international tax. If you look at our tax law now, these are the 3 areas that our whole Income Tax Act covers. It covers general provisions, realization, and income international tax. So things like transfer pricing, arm's length, income splitting, which now they are going to make some small amendment to Section 32, which is base erosion and profit shifting. They are going to add a small provision, but still we use that section and Section 99 of the Revenue Administration Act to deal with base erosion and profit shifting. Okay, when we say base erosion and profit shifting, mostly multinational entities have a way they shift income from a high tax jurisdiction to a low tax jurisdiction by using fees or transferring assets and properties and incomes. I hope that is okay. Yes, these are some of the things that you are mostly going to face, okay? So we are saying that these things, are going to align our domestic tax rules with current international tax rules. And actually, when you look at the income tax internationally, the OECD or the UN double taxation agreement or the model tax convention, and compared to our laws, you see that there are similar principles that our law adopts, like participation exemptions, exemptions with progression. They are all captured under our law. Reciprocity, like Section 7, exemptions of income. Okay, our law covers all these things, and I think it's a good initiative, right? But some few things need to still be considered. So that was the objectives of the Income Tax Act. Though this is not particularly an examinable question, you need to know why the Income Tax Act was created to learn it well. Because I'm not only teaching you for exam, I'm teaching you to also become the best of practitioners that you can be. Is that okay? So this is one thing that you must understand. But one thing I will plead with all of you, whether you are joining class or you are not joining class, CIT has changed. CIT has changed. If you do not practice and you just listen to what I say in class and just say that, oh, I know that, oh, this thing Bill has taught me before, or oh, this thing I know, you will fail. I'm not telling you jokes. Because see, until you practice and build hand-to-eye coordination, you may see a question that is very simple and you get confused because you do not practice. And that is the purpose of these practice sessions. We are going to practice. Even today, we are going to solve so many questions that you get tired. Yes, that is my style now. I don't talk plenty. So just prepare. I hope you are all with your notebooks and then you are ready. Just give me a thumbs up if you have your notebooks available, right? Just show by hand. Give me a thumbs up because we are going to start solving questions immediately. Just give me a thumbs up if your notebooks are by you. Okay, only one hand is up. Only one hand is up. Do you have your notebooks by you? Okay. But after this class, make sure you get yourself a foolscap notebook, right? So these times are just for practice, okay? So we'll start solving our new question right away. So let's go to the imposition of income tax, okay? Income tax is payable for each year of assessment by in Ghana. You can only have income tax when 2 things happen, okay? 1, when you yourself, you have a taxable income, or 2, you have received a final withholding payment, which you have to pay to the Commissioner General. So there are two ways which you are liable to tax in Ghana. Either you have received money for which you have to withhold and go and pay, or you yourself have money that you owe the government. Do you get a rule? So it's like, okay, let's take ABC Limited, right? This is a simple company, ABC. Now, ABC himself has chargeable income, right? This is chargeable income, which ABC has, and ABC has chargeable income of 100,000, right? Okay. Now, this 100,000, ABC, if it's a normal company, ABC will be paying tax at 25%, giving us what? That'll give us 25,000, is that also? Okay, which is ABC's tax liability. Now, he has chargeable income for the year. He's going to pay tax. He's liable to tax on it. The same way, ABC might have withheld, right? He has some withholding taxes that he has withheld, right? These withholding taxes, let's say, amount to, let's say, 12,000, right? This 12,000 is also money that is due to the Commissioner General. So overall, his total tax liability is what? 37,000, which arose because he had what? Chargeable income and he had withholding payments. So the theme of CIT income tax, or what we call corporate tax liability questions, always have chargeable income and final withholding payments as part of the question, because this is the theme. You get it? Chargeable income, final withholding payment. Now, let me show you a typical question of this sort, right? What I'm saying. We can get a typical question around what I'm just saying. Let me show you something. Let me see if I can get a question around that. Advanced taxation. Please hold on for me. Okay. I hope you can see my screen. If you can't see, you just put it in the chat for me, and I'll be ready to answer. Aha, I've seen some. Look, this is a typical question. Nipania, you can see. So this one meets the definition of what we are doing. So you see a question which has been in the scrap business since 2018. His main client is an iron rod manufacturing company in Tema. The company has come out with a policy that all their clients should be registered limited liability companies. So Nipania, therefore, registered on Nipania Company Limited under the Companies Act 2019 at 992 on 21st January 2021 to take over the activities of Onipanua. Onipanua was not a registered taxpayer, and the company was not also registered with the tax authorities. After registration with the Registrar General's Department. The activities of the company came to light when the company's main purchaser of fish scrap materials again insisted on the production of a tax clearance certificate from its suppliers in compliance with the Revenue Administration Act. The MD proceeded to the Taxpayer Service Center of the GRA in Legon to seek further clarification on the submission of tax clearance certificate. The managing director then presented his tax credit certificate totaling 12.8. So a tax credit certificate is presented if you are the one who taxes have been withheld on your income, but that same income, you added it in computing your main tax. It means that, let's say you have paid rent already, right? You've paid rent in advance, and then you pay the rent again. So they have to give you a credit. That's what a tax credit certificate stands for, right? So if you have withholding taxes on account means on account of your income. You've already paid the tax on that, but it was still added on your income. So you need a tax credit certificate to claim a credit or a reduction against your income. Okay, a credit is a type of tax reduction. Okay, it reduces your tax itself because you've already paid. Okay, which is 12.8 to the scheduled officer as evidence of tax paid. Now the MD later approached you as a tax practitioner to help the company complete the tax returns on its business operations to the GRA. Okay, so they've given you a strat of the company's. I get it. And definitely when you look at the company, you see it has turnover, it has cost of sales, it has gross profit, admin and general expenses and all that, right? Now, one thing you will see is that when a company is non-compliant, it means it is not complying with the rules specified under Section 1, meaning you should have income, I get a chargeable income or income, I get it, which is subject to final withholding tax or subject to withholding taxes, right? So withholding payment subject to withholding taxes and then your chargeable income. So when you look at this question, you see that this is a typical question students never like. But the whole thing is that definitely you would have to compute the chargeable income of this company by definitely doing tax adjustment, right? Meaning that you have to take his profit for the year and add back non-taxable deductions or non-allowable deductions, not so, and then you get your chargeable income. But here too, you realize that there are some things that are subject to withholding taxes. I haven't taught you withholding taxes yet, but I'm just giving you the idea. So we have goods, works, and services. So you see purchases, they sell goods. If it's goods, it's 3%. Cargo truck is goods, 3%. Are you getting it? They bought computers and accessories, goods. You have to subject it to withholding tax. Furnitures and fittings, subject it to withholding tax. Fuel and lubricant, transport and handling. We have direct labor cost. Labor is what? They will give you a rate because labor, we use the graduated rate because it's individuals. Then directors pay. Is directors fees is subject to 20% withholding taxes. Consultancy fees is service. You pay 7.5. We have stationery being goods, 3%. You have rent for office building, 15%. You have rent for residential properties, 8%. You can see equipment rentals. Any rental apart from houses is considered a service, right? So if you rent a car, it's a service. If you rent any other thing apart from a house or a residential or commercial property, it's considered a service, so it's 7.5. Okay, if you're in the sale or letting of businesses or sale of, let's say, a real estate company, then you do not do residential and commercial. You consider the real estate as a service in tax, so it's 7.5. Okay, so you see this question has that theme, right? That, okay, we have chargeable income and we have what? Income from withholding, okay, which you have to pay taxes on. And these are the things I want you to keep in mind, okay? So let's go back. Now, we have seen that anytime somebody has these two things, that is when what? Tax arises on his income. Chargeable income, final withholding payment during the year. I get it. And how do we calculate the tax payable? We calculate the tax payable by applying the relevant rate of income taxes to the person's chargeable income. Then we have to subtract any foreign tax credit allowed to that person for the year. Okay, so our main theme today is to impose income tax on people's income. And that is what we are going to learn today, right? So first of all, we said you must have chargeable income. That means we must understand what chargeable income is. So what then is chargeable income? Chargeable income of a person for a year of assessment is the total of a person's assessable income for the year from each employment, business and investment, less the total amount of deductions that are allowed to that person under this Income Tax Act. Okay, so it's like when I take your assessable income, we must understand what assessable income is. So we take your assessable income, whether it's coming from employment, business, or investment, and then take any deductions that are allowed to you under the Act. I get in it. And then what? Take it out. That gives you chargeable income. It means that you must get assessable income before you get chargeable income. I hope that rule is well understood. I hope that rule is well understood. Give me a thumbs up so that we can go. I hope that rule is well understood. Nice. So there's a new concept that was introduced recently, okay? And then it has not been examined before. It was introduced, I think, in 2023, somewhere in June. The amendment happened. It's called minimum chargeable income, okay? So basically, we are saying that your assessable income, okay? We'll come and look at assessable income. Your assessable income, which is basically your income from employment, business, or investment, less your what? Your deductions allowed, right? Any deduction or for individuals, reliefs that are allowed to them. I get it. Must give you what? Your chargeable income. Is that not what we just learned? Yes. This must give you your chargeable income. Now we are saying that companies unfortunately the meeting is not recorded. Wow. Nobody told me. So we are saying that when it comes to your chargeable income, right? You have your assessable income less deductions or reliefs if it's individuals to get your what? Your chargeable income. Now, there's something we call the minimum chargeable income, which was introduced recently. And it's saying that it is a new tax regime which has been introduced for businesses with losses in the previous 5 years of assessment, okay? So if you establish your business and you kept making losses, now people, this is actually an anti-avoidance provision, okay? Though it's a new regime, it's an anti-avoidance provision to stop people from doing tax avoidance. This is an anti-avoidance provision. Why is there an anti-avoidance provision? Because a lot of people, you see, remember that profit is not cash. They may have a lot of cash reserves, but they'll be declaring losses, and the bosses or the managing directors and the other directors and management personnel will be driving huge cars, making a lot of property, but they'll be recording losses. Now, which sensible person will be running a business and will be making losses consistently for 5 years or more and still be running as a going concern? It doesn't make sense, right? This is why you get the chance, to close your business down if over 5 years you are making losses and you are still operating business. It's very bad. Okay, so this one cannot be done. I think some people said they want to unmute and talk. You can put it in the chat section for me, but after each section, I'll give you a chance to ask all your questions. I'll break and give you a chance to ask all your questions if that's okay with you. But I don't want interruptions. You see people's voices and then the background and stuff like that. So you can either put your question in the chat section for me, I'll answer you, or after each section, I will give you a chance to ask all your questions and then I'll answer you. I hope that's okay. So we are saying that, okay, this provision or this anti-avoidance provision has been brought that any business which has made losses in the previous 5 years of assessment, right? They are required to assess and pay tax on their minimum chargeable income, which is specifically 5% on their turnover. So we are saying that, okay, if you make losses, now we are not going to subject you to tax on your income, like your chargeable income, but we create something we call a minimum chargeable income, which is 5% of your sales, right? So this 5% of your sales now is going to be your minimum chargeable income, for which we look at the industry you're operating and we are going to apply the tax rate on it, right? So now, even if you make losses, you can still pay taxes. But you must understand that unless you hit that 5-year period before this provision will be applied. That means there's still tax planning around this, but we are not learning that. We are learning how to be compliant. Is that okay? So let's look at the applicability and exemptions for this provision, right? Then we'll take a simple question. Now, businesses with losses in the previous 5 years of assessment are subject to the minimum chargeable income regime. What are the exemptions? So within the 5 years of commencement of operations, you are exempt. If this is the very first 5 years you are operating, you are exempt from tax. Please, this rule, keep it all, because they may trick you in a question. So if this is the very first year or the very first 5 years you are operating, then you are not going to what? Be subject to this minimum chargeable income regime. And farming businesses are also exempt from the minimum chargeable income regime. Please, I hope you are getting this. So be putting down some short notes. Now, how do we tax during the loss-making periods? Now, it creates an additional tax cost. So the introduction of the minimum chargeable income regime implies that businesses might face taxation even during period of losses. This represents an added tax, okay? Another tax cost for businesses already experiencing what? Financial losses, okay? Which is the downside of things. But then I told you this is an anti-avoidance provision, meaning it stops people from doing what? Unnecessary tax avoidance or tax what? Planning. I hope that is okay. Now, what is the deductible expense implications? Now, the tax that you are going to pay, usually when a tax happens like this, you can charge it as an allowable deduction, but the tax that is paid under the minimum chargeable income regime is not considered a tax deductible expense. It means that businesses cannot offset this tax payment against their taxable income for the purpose of what? Reducing the overall tax liability. It is not possible. So it means that if you make a loss and then you pay minimum chargeable income, it's a tax that you have paid. Even in future periods when you make profit, you cannot set this tax off. You have to pay it. So it becomes like your normal tax liability, which you have to still pay taxes on it, even in installment, right? So I'll teach you how to do all that. Now, what is the provision for future loss-making periods? Now, businesses that anticipate future loss-making periods are advised to make provisions for the tax assessed under minimum chargeable income tax regime. So how does that work? So if I'm anticipating that, okay, I've made losses in these 3 years or in these 5 years, and I expect that from next year I'll be making losses still, then I cannot use the normal income tax regime. Instead of filing nil returns, I must go with this. I must start anticipating and filing returns based on my estimated what? 5% estimated turnover, right? So it means that, okay, let's say that as of this year, this is my 4th year. Okay, this is my 4th year I made loss. And I know that from next year, I'll still be making loss, right? So in the 5th year, from let's say the 1st quarter, remember in Ghana, we do assessment quarterly. So the 1st quarter, I'll estimate the revenue that I'm expected to make next year, right? And say, okay, for the whole year next year, I expect to make revenue of, let's say, 2 million Ghana cedis, right? So this 2 million Ghana cedis estimated revenue, what will happen to this? I will say, okay, I need my minimum chargeable income because I know the costs are going to eat up the revenue. So we are just using this provision as a way to eradicate the cost part. I get to the cost part and just deal with the tax. So the minimum chargeable income now becomes what? 5% of what? The 2 million. That's what? 5% of the 2 million gives us what? That's 100,000, right? So we are saying that, okay, now this 100,000 is our minimum chargeable income. Now we are going to get our estimated tax payable. Okay, so estimated tax is going to be 25% of what? This 100,000, right? And that gives us what now? That's 25,000 per annum. Remember, tax paid is for the year. Now, if this is 25,000 per annum in this, let's say 2025 year of assessment, which I expect that I will start making losses, I will assess based on this. So this is for business planning considerations or basically tax planning, right? This tax planning considerations in periods where you anticipate to make losses. And here I told you we are not talking about businesses that have just started operations, but businesses which have been in operation. So this 25,000 now, in the 1st quarter of that year, we are going to estimate our tax. And in Ghana, what we do is that we take our estimated tax that we've done, less any taxes previously paid, all over the number of quarters available, right? This is what the law says. It says what quarterly payment is A minus B over C, right? So this is A estimated tax, B is the previous taxes, and then the number of quarters. So we are saying that the 1st quarter is 25,000 also. There were no previous taxes paid divided by 4 quarters remaining, right? So we are saying that, okay, so every period, how much are we going to pay as tax? That means each quarter, we are going to pay 6,250. Okay, and this planning that we have done here is so good because at the end of the day, you know how much tax liability you are subject to. And without this, you cannot even get a tax credit certificate, okay? Let's say, or a tax clearance certificate if you want to clear goods, do business with some agency. I get if you renew your practice, you need this, okay? So now this is a new regime, and I know a lot of people are still not familiar with it. They just read it and they don't understand, but it's that easy. I hope you learned something. So every quarter, this guy is going to be assessed on this 60/50 until it is revised, because anything that is an estimate can change. So let's say you change from what? A loss-making position to a profit-making position, then you can still what? Change this, right? Revise this, meaning the revised one will now be based on your actual chargeable income computation and not the what any revenue gaps which may be subject to tax audits. Do you get the idea? So it is that simple. So we are saying that this proactive approach will help in managing your financial obligations and ensuring compliance with the new tax regulations. So please get this and get it well. So we'll be getting to our first Q&A session very soon. Now, there are some strategic considerations that you need to carefully evaluate the impact of this minimum chargeable income on your financial health and tax planning strategies. Okay, strategic considerations should also be made to navigate the additional tax burden during periods where you make losses. Okay, so these are the rules of the minimum chargeable income regime. Okay, so that was it for the minimum chargeable income regime. If you have any question, kindly post in the chat section for me, and I'll be ready to answer you. Who has any question for me? Who has any question for me? Okay, it seems nobody has a question. So let's take a simple scenario, right? A simple scenario here. Let's see. Okay, so let's see, this is ABC Limited. Okay, so ABC Limited has been in operation for long, but let's look at his years of assessment. So let's start from 2019. So 2019, he made profit, right? Profit of 120 million. We are working in thousands, okay? 120 million. 2020, he made a loss of 180 million. 2021, he made a loss of 140 million. 2022, made a loss of 285 million. 2023, made a loss of 400,000, right? And this year, as at now, we are still in the 2023 regime because the file returns this month. Okay, so with this said, let's assess whether this guy can apply the minimum chargeable income regime, right? So we have to count for the previous 5 years. For the previous 5 years, does this guy make losses? Okay, so if you count 1, 2, 3, okay, we have 1, 2, 3, 4. I get it because from here, this is the first one. So the first 5 years, if you go back 5 years, 1, 2, 3, 4, we only have 4 years if you go back. So let me just introduce 2018, right? 2018, he made a profit, right? Profit of, let's say, 100,000. Now, if we look at this, can we apply the minimum chargeable income regime? Yes or no? Just post it for me quickly. We have a lot to do. Since you are spending so much time here. Yes? Can we apply? It's a yes or no question. Just post it for me. Can we apply? It's a yes or no question. Can we apply the minimum chargeable income regime? Yes? Can we apply the minimum chargeable income regime? Just post it for me. Can we apply it? Nobody is saying anything. We are counting 5 years back. I'm asking, does this guy qualify? The thing is to identify whether the person has qualified. Has the person qualified? Yes or no? And nobody is saying anything. Okay. Okay. We can't apply since losses made are not up to 5 years. That is true. You cannot apply, right? Let's change the scenario. Let's now change the scenario here. Okay. Let me change the scenario a little. Okay. So 2017 made profit of 100,000. Okay. 2018 made loss 190,000. 2019 loss of 125,000. Does he qualify now? Does he qualify now? Yes. So in that case, now that we've got this one, are you getting it? Now that we've seen that he has qualified, it means that this year, this income that we have, because when we go the previous 5 years, he made losses continuously, right? And we must know that I gave you some exemptions. What are those exemptions? I told you that one, new businesses, right? Who are in the first 5 years of their business do not qualify, right? New businesses who are in the first 5 years of their business do not qualify. And two, businesses who are into farming, right? Okay, it seems people remember. Yes, new businesses and businesses who are into what? Farming businesses do not qualify for this, right? It means that when you do not fall in this category, then you have to pay the taxes around it. So we are saying that, okay, this is what we have. And let's say that this guy had this loss of 400,000, right? But during this period, this was his turnover, right? So he had sales. Let's see. So this is his turnover, right? Of 2.8 million. Okay. This is turnover of 2.8 million. And then we have what? Expenses. So let's say these are his allowable expenses, right? But these expenses are worth what? supposed to be 3.2 million, right? So that means if we deduct this, we end up with loss of how much? What's the loss? Loss of 400,000. Is that not so? Okay. Now this 400,000, this is it. But remember that this turnover is goods. So these goods will be subject to withholding tax at 3%. Who agrees? So this 2.8 that we have, what's 3% on 2.8? Let's do the calculation. That's why I said you have to be with your calculators, because we'll be practicing. Though we are doing small questions now, we'll start doing big ones. That means how much withholding taxes is this guy subject to? That means he would have paid 84,000 on this, right? And still include the total amount in his income. So this amount has been withheld, right, by the withholding agent. So provided you have a tax credit certificate, you can claim this as a reduction. I hope that is okay. So now that we have this, it is telling us that, okay, this guy qualifies, he has qualified for what? The minimum chargeable income regime. So what then do? We are now going to take what? His minimum chargeable income, which will be how much? What's his minimum chargeable income? Minimum chargeable income will be what? 5% of his turnover, right? 5% of turnover, which is how much? Just 5% by 2.8 million, right? And that gives us what? Please do the calculation for me. 140,000. Yes. So we have 140,000 as his minimum chargeable income, not so? Minimum chargeable income, 140,000. Then we say, okay, this is your minimum chargeable income. What becomes his tax payable? What becomes this guy's tax payable? In this industry, you pay 25% times the 140,000, which is the minimum chargeable income. The tax authorities want to be fair with you. So 0.025 by the 140,000, meaning he's going to pay tax of what? 35,000, right? So this is tax liability, literally, right? So we've got this guy's tax liability, but already you realize that this guy has what? Withholding taxes of 84, which can be claimed against this 35 still. So literally, you won't have any tax liability, right? You have a net credit, okay? But that one is subject to what the authorities are going to say, whether they are going to allow you all to claim your credits. Then definitely, yes, you should be allowed to claim your tax credit. So that's how we dealt with minimum chargeable income. I hope the calculation is okay and everybody is okay with minimum chargeable income. If you have any questions, you can feel free to post it in the chat for me, and you can also what? Also ask your question via the chat. Okay, so that was minimum chargeable income. I hope everybody is okay with it, and we can go back to our sessions. Okay, so we've dealt with chargeable income. We know what chargeable income entails, and then now we are moving to assessable income. Now, before we go to assessable income, just a quick brief, because you definitely be computing income. So for chargeable income, let's learn the basic, right? The basic approach to do chargeable income for a company, right? So the basic approach for a sole proprietor business, mostly we use this for businesses and then individuals. So most of the time, you reverse the accounting the person has done. So we take the profits before tax of this person, right? So let me just create two columns. Okay, then we just know the basics will help. So we take his profit before tax. Then we are now going to lay some incomes that was added to his gross profit or added to his accounting income, which tax does not, those incomes are not taxable. So I call them non-taxable income, right? So So basic approach to determine your chargeable income, right? So this is how we determine chargeable income under our Ghanaian tax law and other tax laws as well. So we take its profit before tax, then we less any non-taxable income that was added to its income, particularly in accounting your gross profit. And this non-taxable income includes two main things. Let's say three main things. One, we have what? Final withholding payment. So if you have any income which is subject to final withholding tax, okay, like dividends, rent, okay, this final withholding payment, because they've already been taxed, they do not belong here, right? Because something you've taxed already and you are including it in your income, right? You have to take it out. Then if you have any income which is exempt, okay, any income which is exempt, it doesn't belong here. You also have to take it out, right? So final withholding payments are supposed to what? Not be here. So final withholding payment, we look at these rules. Then exempt income, we look at these rules too, right? They do not belong here. Then you cannot include, assuming this is an individual, you cannot include his employment income, okay? We cannot include what? Employment income in your what? Your accounting income, right? So employment income is not also supposed to be included. So these ones are all non-taxable income, which we have to try to take out because they do not belong here. Are we okay? So once you have been able to do this, then the next stage is to also add back anything that you deducted, right? You are going to add back anything that you deducted, any deductions which the tax law does not allow. So this is what we call what? Disallowable deductions, right? Okay, so these are expenses which are not what? Allowable. So disallowable deductions, okay? And they are common types, but just get these basics before we go, right? That is how you go about it. So do you have any particular questions that you want to ask? Okay. You said how many types of chargeable income do we have? Oh, your chargeable income is just your normal chargeable income, but the chargeable income that you can consider maybe somebody's business chargeable income, maybe the chargeable income came from business, it came from investment, or it came from employment, right? Basically, assessable income is from three sources. Chargeable income is also from that same three sources, right? And it's a sum total of all of your income. Are we okay? So basically, when for businesses and individuals, I get it. Somebody said what? Standard and minimum. Okay, basically, yes. The standard one is what we are learning how to compute now, and the minimum is what we learned, right? Earlier on. So we are saying that, okay, so for disallowable deductions, basically, we have what? Income, expenses that are not wholly, exclusively, and necessarily incurred, right? We call that what? When. So it meets what we call residual deduction rule. So expenses that do not meet the residual deduction rule. And these expenses are covered under section 9, okay? So any expense that does not meet this is not allowed, okay? So it's a disallowable deduction. Then we have expenses which are excluded and domestic expenditure. So if you have any excluded and domestic expenses, okay, these ones are not also allowed. Section 130, these expenses are not also allowed. Then we have expenses that are of capital nature, okay? So if you have expenses that are of capital nature, let's say you bought a plant and equipment, you bought computers, and you charge this as a deduction from your accounting profit, we will add them back, okay? So this one too, section 9 talks about it. And then other sections, specific sections have some limitations, right? Specific limitations too are there. Okay, so apart from this one, there are other limited expenses. When we say limited expenses, it means that there are some expenses that the tax law from section 10 down to section 17, there are some limitations. I get about some expenses which should not be allowed. So once you get all these ones, you add them back, and then you come and get your adjusted profit before tax, right? Which is literally your assessable income. So your adjusted profit, okay, which is like your assessable what income, okay? Which is like your assessable income here. Then you now go and list other deductions which you did not what? You did not deduct. So other allowable deductions. So we have other allowable deductions. And these other allowable deductions, they are all specific deductions, right? They are all specific deductions which the law specially gives. So we'll come and deal with all these in our subsequent lessons. And this is what now gives us what? Our chargeable income, right? And this is what now gives us our chargeable income. So this is like the standard chargeable income that we have, right? This is the standard approach. Okay, though you have other incomes that you can add. So for instance, as I got my adjusted profit, I can add other income. Okay, so other income here is basically telling us that if you have investments, if you have any investment income which is on account, I can add it to this, right? Before I now come and take out my what allowable deductions and then get my what my chargeable income. Okay. So that is the end of our first session, which now we would stop, and then you can now ask all your questions. So you have room for questions now, which you can unmute and ask your questions before we start the next session. Yes, you can unmute and ask all your questions. I'm okay. Yes. Please, your questions. Oh, you said you wanted to talk, so you can unmute. Everyone can unmute and talk. I've unmuted everyone. You can unmute yourself and talk.
Yeah, Bill.
Yes, boss.
Yeah, good evening, sir.
Good evening, boss.
Good. I think that as we are going along, you are building on some aspects of the lesson. So if we don't understand the initial part and you build on it, it becomes difficult to follow. Some of us were having internet challenges, so combining both and all that. So I was thinking if we had the opportunity of asking questions as and when, at least you understand up to a point, even if the internet goes off, so that you can follow. I was having a challenge this evening.
So why that is happening is because I'm actually streaming on YouTube as well. So I didn't want interruptions. But if people discipline themselves and just unmute as and when they want to ask questions, then I do not mind, because sometimes you see people's background noises and other stuff. That is why I basically mute everyone. But if you have any question, this is the Q&A session now. You can ask your questions and then we move on. I hope that is okay. Do you have any specific question you would like to ask?
Let's go on, maybe when we get to another point.
Okay. That means nobody has a question for me again. Anyone? Okay, that means nobody has a question for me. Nice. Does that mean everybody understood?
Hello, sir.
Yes, boss.
Yeah. When you were computing the minimum chargeable income, the example you said,
Yes.
on the withholding, you came out with 84,000 as withholding of 3%. That one, is it assumption?
We are assuming that he sold goods. If he provides services, it will be 7.5. If maybe he's into contract work, it will be 5%.
And on the basis that he's a compliant.
You say on the basis, oh yes, on the basis that so far as you sell to somebody, even if you are not compliant, so far as you sell to somebody, before the person pays you your money, you would have withheld before paying you. So that one, whether you are compliant or not, your income, the person must pay. The person will withhold and go and pay. We are assuming that on the other side, the person has done his end of the game. Like he has done his, that is what we are assuming questions.
So whether you've received the TCC or not, you can set that as a credit.
Yes, you state your assumption in the question. That's how we do exam.
Thank you, sir.
You're welcome. Is that okay now for everyone? So now we go to division 2, which is assessable income. Okay. Now, assessable income of a person for each year of assessment is the income of that person from any employment, business, or investment. And the assessable income of a person for a year of assessment from any employment, business, or investment is 1. In the case of a resident person, you remember that when we started, I told you that anytime you're dealing with tax, think about the person. What did I say about persons? Yes, I said something about persons. I said persons can be grouped into what? Persons can be grouped into what? You can unmute and talk.
Individual and entity.
Okay, individual and what? An entity. An entity, I told you entity can be what?
Sole proprietor, company,
Could be an
and trust. Yeah.
Okay. So you could say a sole proprietor. Okay, anyway, which will still be an individual, but here is a business, right? I said, well, it could be a partnership, could be a company, could be a trust, and then it could be what? A body of persons. It could also be what? A permanent establishment. Okay. So these are the rules that you need to understand when it comes to persons, okay, under our tax law. There's an extension of it. Okay, so we are saying that if you are a resident person, meaning you are either of these in Ghana, okay, then the income of that person from each employment, each business or investment for the year, whether or not the source from which the income is derived has ceased, this is what connotes what we call worldwide income. So no matter where you make your income as a Ghanaian or a Ghanaian resident, right, whether or not the income you received is no more from wherever you incurred or earned that income, it means that that income is subject to tax in Ghana. This is what we call worldwide income. So it means that if you are a resident of Ghana, any income that you make, no matter where you make it, from anywhere in the world, is still subject to tax in Ghana. However, Ghana can give you a method of relief against that income. It means that you are going to what? You are going to what? Bring the income by all means, right? And we are going to what? Grant you a relief against that income. I hope that is well understood. So that is it. Now, for a resident person, incomes have various sources, right? And I say worldwide income, meaning income that is in Ghana here, income that you made in Ghana here, and income that is in what? A foreign what? Country. Do you get it? So let's say if I had income that was brought into Ghana, okay? If I have income that was brought into Ghana from a foreign country, and income that was what? Received in Ghana from a foreign country, these incomes connote a foreign source. Do you all agree that these incomes have a foreign source? Do we all agree that if I bring income from a foreign country into Ghana, then it has a foreign source? True or false? True or false? Oh, you can actually talk.
True.
True, yes. And then if I derive income from Ghana, I work and derive income from Ghana. So income derived from Ghana and income accrued in Ghana. Where is the source of this income? Is it in Ghana? Did I derive it from Ghana or it has a foreign?
Yes, in Ghana.
So it has a domestic source. Is that not so? So we are saying that yes, this person, so far as you are a resident individual, resident company, resident partnership, resident trust, or a Ghanaian permanent establishment, any income so connected with your business is subject to tax in Ghana. Do you get a rule? So we are saying that, okay, we saw bodies of persons, right? We saw persons as partnership, trust, company, permanent establishment. But for a permanent establishment, it can only be created when a non-resident has a business in Ghana. What did I say? I said what?
Non-resident person in a business in Ghana.
Yes. So it can only be created when a non-resident has a business in Ghana. Do you get it? So we are saying that if we say a permanent establishment, it means that you have established yourself permanently. Okay, so if you are a non-resident person, okay, and you come to Ghana and you come and create a business, so far as you have a business, that business creates what we call a permanent establishment. And a permanent establishment, are you getting it? Any income that is attributable to the permanent establishment. Remember, I told you a permanent establishment is also a kind of person, right? When we look at person, so it means that a permanent establishment in Ghana is also taxed on worldwide income. So this is the proof under section 3. This is the most powerful section in the act, which people usually do not even look at. So we looked at, in case of a resident person, we said, well, whether or not the source from which the income is derived as what? As seized. And I said this connotes what? I said this connotes what?
Foreign income.
Worldwide income.
Yeah, worldwide.
So that income can come from Ghana or it can come from a different country. It doesn't matter where it comes from. But so far as the income was generated during the year, it is subject to tax in Ghana, provided you're a resident. So in Ghana, we do not only look at the source of the income, but we look at wherever, so far as you're a Ghanaian or a Ghanaian resident, the income is derived. I hope that is well understood. Now, let's go to a non-resident. So there are two types of persons, a resident person and a non-resident person. So if you're a non-resident person, the income of that person so there are two ways. Either you are just a non-resident who is just doing his normal activities as an individual, or you decide to do what? A business. Do you get the approach? So if I'm a non-resident person, let's see, and I just come to be employed in Ghana, then I'm a non-resident individual. Do you all agree with me? Do you all agree with me? Okay. What if I'm a non-resident person? Let's take Kenichi Ime. Kenichi Ime comes to Ghana, a Japanese, sets up a company here. Would that be a non-resident individual and now he has created a permanent establishment?
Permanent establishment.
Or he has a branch here. It creates a permanent establishment, yes. So he having a branch here is telling us that this guy has an external company and that external company now becomes a permanent establishment. So can we say it's a non-resident individual now? Or it's a non-resident business?
It's an entity.
Yes, so a non-resident business, right? So for a non-resident person, it's either we are dealing with individual or we are dealing with what? I get it. We are dealing with what? A business. So if it is a non-resident person, the income of that person from employment, business, or investment to the extent that it has a source in this country. So we are saying that, okay, so when it comes to non-residents, we do not look at worldwide income. We only look at incomes that have what? A source in this country. Do you understand? So if you are not resident, the income must have what? A source in the country. And I gave you income which have a domestic source and income which have a foreign source. Which incomes have a domestic source here? I mentioned two types. Income which is derived what? From Ghana, not so. And income which is
accrued
in Ghana. So with what we said now, let's see if Kenichi, let's look at Kenichi, right? If Kenichi came to Ghana, let's say he came to Ghana in 1st January, right? And then Kenichi brought, let's say he brought 180 million yuan to Ghana, not so, and then received remittance from his wife, okay? He received remittance of 240,000 yuan, okay, from his wife in Ghana. Would it be subject to tax in Ghana? Would it be subject to tax in Ghana?
So is the wife living in Ghana?
No, I said he received a remittance from abroad.
Okay.
And then he also brought, when he was coming to Ghana, this is the money he brought. Okay.
Once is that? non-resident company, then that money is not subject to tax in Ghana.
Once he is a non-resident, you get it. So where does this income fall? Does it have a foreign source or he has a domestic source?
Foreign source.
Foreign source, meaning this income was what brought into Ghana, right?
Yes.
And this one was what received in Ghana from somewhere, right?
Yes.
So they will not be subject to tax. Okay, because Kenichi is not a resident here. But let's look at the Chinese employment. Let's say they employed him in a Chinese restaurant, right? And then they paid him a basic, right? They paid him basic of, let's say, 100,000 annually. He's the chief chef. Okay, so Kenichi came to Ghana to become a chief chef. Okay, he prepares sushi and other things. And apart from that, he invested, are you getting it? He invested in a company and he's receiving dividends, right? So he received dividends of 120,000 cedis during the year. My question is, which of the incomes are subject to tax on Kenichi's income?
Okay, so with the investment, is he investing in a resident company or foreign company?
No, he's in Ghana. So the assumption is that it's a resident company he has invested in.
Then the investment will still be subject to final withholding.
Yeah, so the question is,
The
which
dividend.
of Kenichi's income will be subject to tax? That is what I'm asking.
Or the income from employment and income from the investment. What will be subject to? One will be subject to normal chargeable income, and one will go under final withholding.
So we are saying that this income was derived from Ghana and this income was accrued in Ghana, right?
Yes.
Okay, so we are saying that, yes, with this being said, it gives us the general overview that so far as you are non-resident, unless the income has a source in this country. Remember, these ones have no source, but these ones have a source in the country, right? And once they have a source in the country, they are subject to tax in the country.
Hello, Bill.
Yes, boss.
Please, I was trying to understand the derive from and accrue from. Does it mean the derive from is what he's actually worked from, like employment that he's gotten as an employee? That should be derived from Ghana. Is that the difference between the derived and accrued in Ghana?
The actual meaning of accrued and derived,
Yes.
sometimes people say that, okay, derived from means the source has ceased, and accrued in means that it's still being incurred, right? You are still earning. But the thing is that derived from signifies active income, okay?
Okay.
The employment income is active income, where dividend is not active, right? The nature of it is we accrue passive income. We do not derive passive income. Makes sense?
Okay. Okay.
So derived from signifies active income, income that you're actively working for. And accrued in is income that is accrued in a fund, an account, or something, right? Makes sense?
Okay. Right.
Okay. Is everybody okay now? Can we move?
Yes.
Okay. So now that we have understood, we will still be, please write this question down. We'll be making it a full question. Just write brought into Kenichi, then underline brought into Ghana. You want 180 million remittance. I get it. Just simple. Don't write anything else. Just write the amount. Then Ghana, employment in Chinese restaurant, investment in company, dividend 120. Quick, so that we move quickly. And then we go to the next area. Can we go now? Can we go now?
Yes, sir.
Okay. Can I clear the screen? Okay. So now the next area, we have to focus on is the issue of residence and non-residents. Okay, and this ones, it seems students just want to jump into calculations without understanding this thing. And now that is remember that so far as you are doing tax, you must know the entity or the person you are taxing. Okay, so before we move there, we saw that, okay, if you are an individual, Kenichi is an individual, right? So we saw that any income that Kenichi makes from business, employment, or investment, provided that it has a source in Ghana, it is either derived from Ghana or accrued in Ghana, then it should be taxed in Ghana. Do you understand? But what if Kenichi had a business, meaning he has what we call what? A Ghanaian permanent establishment. If Kenichi has a Ghanaian permanent establishment, then income for the year that is connected to the PE, irrespective of what? The source of the income. This also connotes worldwide income. So far as Kenichi has a Ghanaian permanent establishment, which I'll come and teach you later, for you to understand the rules of permanent establishments, we are saying that, okay, if Kenichi has a business, okay, in Ghana, basically, if he has a fixed place where he's doing business in Ghana, or a place at his disposal, which he's using as a business, right? It creates a permanent establishment. And any income that is accruing to that permanent establishment from anywhere in the world, so far as it's connected to this particular permanent establishment here, it is subject to tax in Ghana. Okay, this is something people usually do not get. But permanent establishment, this is what we call the force of attraction. Okay, in the UN model of the double tax agreement, we call it the force of attraction. Our laws adopted it. That so far as you have a permanent establishment in a country, anything that is connected with the PE shall be subject to tax at where the PE is located or where the permanent establishment is located. For now, just understand permanent establishment as the business of a non-resident in your country. Is that understood by everyone? These are the principles of taxation, that you need, the basis. If you have this, then when we take a question, it becomes very easy for you to deal with. Do you understand? So we are saying that, okay, where Kenichi now had a business here, or he had a branch of his business which he has in Japan, if he has it here, he creates a PE. And so far as any income is connected with that PE, it is subject to tax in Ghana. These rules are new to you, I know, but as we do more and more, it will unravel, right? For now, just pay attention, make some small notes, follow along when I solve questions, when I ask questions, just participate. That is all I need from you for now. I hope that is okay. So what did I say about permanent establishment in summary? I said if you have a Ghanaian permanent establishment, what happens? What did I say about Ghanaian permanent establishment?
It will be subject to worldwide income tax.
Will it be subject or it won't be?
It will be.
It will be, yes. It will be subject to worldwide tax, right? Because all incomes that are
worldwide tax,
irrespective of its source, will be taxed in Ghana. I get it. So a Ghanaian permanent establishment is treated like any other resident person. That is why when I was adding persons, you realize that I added a Ghanaian PE to it. So it has the same rules. And we'll look at the rules of a Ghanaian PE when we get to PEs, right? So PE is a key theme of your paper now. Now you may go to the exam and they'll just present a PE where you have to calculate what? His chargeable income and get what we even call branch profit tax, okay, under section 60. Okay, so it's a very interesting journey now as you are going to learn everything there is to do about taxation. Income tax, VAT, excise, customs, and even indirect methods of computation of income, presumptive tax, which we call net worth. You have to learn all those things before you become a full-fledged tax practitioner. Okay, so we are saying that the income of a person from an employment, business, or investment has a source in this country if it's accrued in or derived from this country. Now, if you are determining the assessable income of a person or of another person, you have to determine that assessable income for each class of income what? Separately. What did we say? Anytime you are determining chargeable income from somebody or assessable income, you have to determine it separately. It means that you cannot mix up. Okay, so if business, business, employment, employment, investment, investment. When you finish, then you get the totals of each, right? And then you deduct your deductions from it. Do you understand? So that is the basic rule. Any questions so far? Any questions so far?
Hello, Bill.
Yes, boss.
I was trying to wrap my head around the permanent establishment statement you made. So a foreigner has established in Ghana and has the same company in his foreign country. So you are saying that the income that they make in that foreign country should also be taxed in Ghana because he has a permanent establishment in Ghana.
It should be taxed in Ghana. I'm saying that so far as it is connected, when I say income is connected to a permanent establishment or attributable to the permanent establishment, what I mean is if there's any remittance that is sent to the permanent establishment, it becomes income. Let's say that this permanent establishment exported goods outside the country and they paid it. Is it not a foreign source income? Was it not connected to that PE?
Okay.
Do you get it?
Yes.
Maybe the permanent establishment decided to invest in an investment in UK, and then UK decided to send it dividends. Is it not attributable to that PE?
Yes, please.
Remember, the parent business is separate from the business of the PE, right? But the PE, anything the PE does, whether it's in Ghana or it's in a foreign country, it shall be subject to tax.
Noted.
Is that understood? I want
Yes.
you to be asking questions like this so that you get it. I hope that is okay.
Yes, please. Thank you.
Well understood. You're welcome, boss. Okay, so that is it. So we have looked at the issues, right? Now we have to dive into the concept of residence, okay? The concept of residence. So I was telling you that before we do all this chargeable income, all that stuff, I hope you put Kenichi down. The example I gave you, put it down. So let's look at the concept of residence. Now, one thing you must understand is residence is determined yearly for tax purposes. So residence is what? Residence is determined what? Residence is determined what? Yearly for tax purposes, meaning that you can be a resident this year, but you will not be a resident next year. Okay? You can be a resident next year, but you will not be a resident this year. So every year we assess someone for residence. We assess a person for residence. Is it understood? So residence is assessed yearly. Please have this at the back of your mind that we assess residents in Ghana yearly. Every country actually does it yearly too, but just have it. We are dealing with Ghana, so let's look at it from Ghana. I want you to write this statement down. Have you written it down? Residence is determined yearly.
Yes.
Residence is determined yearly. Have you put it down? Can we move now?
Sure. Yes.
So we have to look at residence for every kind of what? Person. So we are saying that residence for tax purposes is defined in relation to individual, partnership, and a company as follows. Now, a resident individual is an individual, who is a resident. And how does an individual become resident? Automatically, when you are a citizen of Ghana, you are a resident. But then there are some caveats to citizens. So there are two caveats, okay? So if we look at a citizen of Ghana, naturally, if you're a citizen of Ghana, so far as you're a citizen, you are a resident, unless one, you have a permanent home, okay? So we are saying that if you're a citizen and you have a permanent home outside Ghana, and then you did not stay up to 365 days in that home, then you are still resident in Ghana. Two, if you are a citizen, but you have a permanent home in Ghana, right? But you stayed outside for less than 365 days, you are still a resident. Do you get a rule about citizens? Do you get a rule? So it means that so far as you do not stay outside for more than a year, you are still resident in Ghana as a citizen. Hello? Does that make sense?
Yes.
How do you understand it?
You're a citizen, but you have a permanent home outside. Yes. Even though you have a permanent home outside, you did not stay there continuously for 365, meaning you were here in Ghana.
Yes. So
you are being considered as a resident.
364 days in UK and I come and stay 1 day in Ghana during the year, am I still resident in Ghana or not?
So come again.
I stay 364 days in UK and I come and stay 1 day in Ghana. Am I resident in Ghana or I'm not?
You are resident.
Yes, you are still resident. If I have a permanent home in Ghana, but I temporarily was outside Ghana during the year, right? But I didn't stay up to 365 days. Let's say I stayed 15 days in Ghana during the year, but I stayed the rest in UK or Italy. Still, I'm resident. So far as you stayed, we saw you in Ghana during the year, you are resident. And this creates something we call dual resident, right? Now, dual resident is a case where somebody is resident, two states are considering you to be resident, okay? Usually the thumb rule days is 183 days or 182 days in another country. So let's say you stayed in UK for 183 days or more during the year, and you came to stay only 15 days in Ghana as a Ghanaian, right? Ghana will say you are resident. UK will also say you are resident, creating what we call dual residence. And this dual residence that will be created, we use something we call the tiebreaker rule to deal with this dual residence scenario. Are we okay? We are not yet going there, but I just want you to understand that you can be resident in two states, two or more states at the same time. And then we have to find a way to solve that issue. Otherwise, you end up with double taxation. Is that okay?
And so what's the way? You just mentioned it, but I didn't get it.
For tiebreaker rule, we break a tie. So the two states, it's like a context to determine where you are resident. So for an individual, usually the tiebreaker rule is dealt with under a double taxation agreement, basically under Article 4, paragraph 2. Okay, so what it says is that we determine the states where you have your permanent home. That's the first test. That's why even in our law, you see, it's permanent home that is there, right? It's permanent home is always the first test. Then if we cannot find where you have a permanent home, we look at where your economic and personal relations are closer, which you call your center of vital interest, where you have your wife, your children, your businesses, your visa administration, okay? So we look at where you have your center of vital interest. Then if you cannot determine that or you have that in both states, then we look at where you stay often, right? Which is your habitual abode. Where do you often stay? If we look at that, we cannot find it. Then we look at where you are national. That one ends the, I get it. So if we say, oh, you're a national of Ghana, but truly to you are also a national of UK, then it's inconclusive. Then finally, the tax authority is determined by what we call what mutual agreement procedures. So they will now say that as a matter, we cannot determine his residence. So what do you think is the next decision? Should we sit for somebody to come and be an arbitrator, which is by arbitration? So if we cannot determine your residence, to avoid double taxation, you submit your case to the relevant competent authorities or the tax authorities of those countries, either your country or the other country. Are you getting it? So either GRA or Her Majesty's Revenue and Customs, and then they are now what? Going to sit down, determine which country is going to tax you, okay? They are going to reach a consensus, and that's what we call mutual agreement procedure. This is when this guy, we cannot determine where he's resident. But did we get a citizen of Ghana classification? Did we get it? Did we get it? So if I'm a citizen and I stay 1 day in Ghana, am I resident or not?
You are still a resident.
I'm still resident. Thank you. Now, if you are present in Ghana, right, and you are not a resident, you are not a citizen, but you are present in Ghana for an aggregate period of 183 days or more in any 12-month period that commences or ends during a particular year we are assessing you for, then you are resident. So this is non-resident. So if with Kenichi, right, I told you Kenichi came to Ghana in January, right, 1st January. Now, even if Kenichi leaves in March and comes back, let's say in May, okay, we have to count the number of days in aggregate. Before it was continuous, and the continuous people were taking advantage of it, meaning that somebody wants to stay 6 months, right, which is the 183 days, but you intentionally stay January to March, then you leave and come back so that you break the continuous cycle. So this new act didn't use continuous, it used what? Aggregate, meaning that even if you leave Ghana and come back, when we aggregate all the periods you stayed, it should be more than 183 days or more, then you become a resident. So with the case of Kenichi, assuming Kenichi stayed from 1st January to 31st March, right? Which is for how many days? That's about 90 days, right?
90 days.
Then he left and came back in May and also stayed up to December. That's how many days? So May is 31. Okay, so we can take 3 months out of 365, right? 90 minus
Yes.
365, roughly.
280 something.
So it's more than 183, definitely, right? So if we
Yes.
aggregate all, you see Kenichi would have stayed more than 183. And once he stayed more than 183, it means that all the income that Kenichi has, both the one that he brought from his wife and the one that he earned in Ghana, will all be subject to tax in Ghana that year because he now becomes resident. You know, this thing doesn't sound fair, does it? Because we learned a rule that so far as you're a resident, all your income, both local and foreign, shall be subject to tax. Is that not what we learned?
Yes.
So, with that being the case, any income that Kenichi earned during the year, irrespective of whether the source has ceased, will be subject to tax in Ghana. No being we learned. That is the rule.
Yes.
By the time that he wasn't resident, it is only the income from the Chinese restaurant and the dividend which was subject to tax. But now that he's resident, because he traveled and came back and stayed up to the end of the year, if we aggregate it, you realize that Kenichi is still what? Becomes resident. So his worldwide income will be subject to tax in that. Makes sense. That's the 183-day rule. So this commences or ends during the year means that depending on which year of assessment we want to assess you, we'll look whether your 183 days fell into that year. So, you know, 183 days can span across 2 years. So let's say if I stayed 90 days in 2023 and spent the rest of the 93 days in 2024, right? If the tax authorities are determining your residence for 2024, it means the 183-day period ended in 2024, right? So they'll count from here to the 2024 and check if they can determine your residence for 2024, whether you were a resident in 2024. If we want to assess 2023 too, we are looking at where the 183 days commenced. We can use that as a basis to determine your residence as well. So this thing is not anything giddy, but that is what it means, right? So we use dates to assess whether your residence falls in a particular year or not. Okay, and there's a way. This thing is quite complex, not very complex, but sometimes it could be subjective, right? Depending on two people, it depends on where you made the most income from. You know that GRA wants to meet their target, so definitely they'll look at the year where you made most money and then shift the 183 days to that year. Okay, I hope it makes sense.
Yeah, but Bill.
Yes, sir.
From the point, you said, from the notes I can see, you said present in Ghana for aggregate of 183 or more.
Or more,
in
yes.
any 12 months period that commences or ends during the year.
During the year.
Yes.
Yes.
So are we not referring to a particular year?
That is what I'm saying, a particular year. So it commences or ends. So I'm saying that this one ended in 2024. So if it ended in 2024, that is what we are using for the assessment, counting from here to where it ended in the particular year. That's why it doesn't say commence and ends. It says commences or ends. So we can either use the end or the beginning to signify where we are going to your residence.
Okay. I get it.
Because look, if we say commences and ends, that means always your 183 days must start in 2024 and end in 2024, right? Meaning I can do tax planning around this. I can let my 183 days start in 2023 and end in 2024. That way you cannot catch me. Oh, that's why it says commences or ends. So this is literally an anti-avoidance provision to stop people from taking advantage of the 183-day period. So the aggregation and the commences or ends are what? Anti-avoidance provisions to stop you.
No, wait.
This is what I was saying, the background noise. I hope that is okay. Are we okay with citizenship and the 183-day rule? Can we go to the next one, which is the easiest? Now, if you're an employee or official or government or a government or employee and you are posted abroad during the year, if you are posted abroad during the year, okay, automatically you are a resident of Ghana. So why is this so? Now, this rule is that when you are posted abroad, automatically you are still resident because you are still a government employee, right? The government of Ghana will still be remunerating you, Okay, so the remuneration is still coming from the government of Ghana, automatically making you still, are you getting it? A resident of Ghana. So this is a special rule of residence. Mostly this was the intended for army personnel who stationed, go for peacekeeping and those things, right? It was stationed for those kind of people. It's a special rule for residents. There are other special rules like exit and departure taxes. Are you getting it? We have the draconian tax system or citizenship-based residence, which Ghana adopts part of, right? So this is basically residence for individuals. And actually, we can still dive deeper. Just like in the law, you know, the law is just surface. The interpretation has a lot of things. Are you getting it? This is just the surface of it, but I hope you understood residence for individuals and even the tiebreaker rule. Is that okay for everyone? Please ask questions. It's your questions I need. Yes? It's your questions that I need. Yes. That means nobody has a question. We are all okay with residence for individuals.
Yeah, Bill.
Yes, boss.
If you are an ambassador, for instance, and the government posts you to a particular country, and they also have a similar rule of 183 days within, that commences or end during the year, can they also tax you there so it becomes a double taxation?
Of course, they can.
Okay.
Because remember, the ambassador also has other arrangements in the other country. Though he's a government official posted abroad, he may earn other incomes in that other country as well. True or false?
Yeah, that's true.
Which can still lead to double taxation. So this will help you in international tax when we get to residence.
Okay.
I hope that is okay. Sure.
What about that ambassador, his employment income?
Yes, then that one is subject to tax in Ghana because he's what? An employee of Ghana posted abroad to represent the country. So that one is subject to tax in Ghana. Unless there are other benefits that the other country provides to him, which will be subject to tax under the laws of that country. Is everybody okay now? Please, are people okay? Shall we proceed? Shall we proceed? Okay. So, with that being said, let's go on. That was an individual. Now, this is where it gets feisty. Resident partnership. And it's very short. And somebody said, what does it mean? See, a partnership is considered resident for a year if any of the partners resided in Ghana at any time during the year. And that is where they ended. Now, this is not fair. Why is it that individual, they wrote this plenty thing in partnership? They just said that if any of the partners resided in Ghana at any time during that year. Then what does that mean? What does that mean? Yes. Oh, I'm listening. Oh, what does that mean?
It means that
Okay.
Yes, I'm listening. Oh, it means that.
since the partnership is not taxed, but the individual partners are taxed, then at any point in time when one of them is even present in Ghana, they are deemed to be resident.
Okay, I like it. So a partnership is actually an entity, right? Okay. But in the partnership, we have partners, right? Not so. Now, in tax in Ghana, we use the fiscal transparency rule in our law, the fiscal transparency concept, meaning not every country does that. But in our law, when we are taxing a partnership, we do not tax the partnership itself, but it is the individual partners who have a liability. So literally, it is telling you that, let me really let you understand this, which people do not understand. It means that, let me write it in a good context for you. A partnership is considered a resident for the year if any of the partners is resident in Ghana. That's the word, is resident. This is resided, is telling you resident, that is tax. It's not pure English there, resided like stayed. Is resident in Ghana at any time during that year, meaning that the rules for individuals, meaning either of the partners, is a citizen of Ghana who has a permanent home in Ghana or outside Ghana, but didn't stay there for what? 365, right? Or
Yes.
he's a non-resident but stayed 183 days in Ghana during a period in aggregate, right? Commences or ends. Or he was a government official which was posted abroad. Okay, but usually this one not work because you are talking about partners, so it's between citizenship and 183 days. Do you get it? So if either of the partners was a resident during that part of the year or during that year, and the other partner was not even resident, it's a resident partnership. Why? Because we tax partners, not the partnership. So it means that even if we are taxing that partnership, it is this guy that we are going to tax and not this guy. Makes sense?
Yes.
Does that make sense?
Yes.
Do you get it? So no matter what happens, we are not going to tax PB. It's PA that we are going to tax because PA is resident in Ghana. PB has no tax liability in Ghana unless the partnership's income has a source in Ghana. Then when we are sharing, we say that, okay, the income that PB is getting, we are looking at only the income that accrued from the partnership in Ghana because it has a source, because PB is non-resident. But PA is resident and hence is subject to tax on its worldwide income. So assuming the partnership did an investment outside, any income that accrued to the partnership, I guess that was brought into Ghana or received in Ghana, will be subject to tax on PA's income. I hope that makes sense. But PB will only be subject to only the distribution the partnership gives him in Ghana. Makes sense? Makes sense?
Bill, why didn't they
I hope
state
it makes sense. Is it understood?
Hello,
And these
Bill.
are the principles you need. Once you get these principles very well, now when you get a question, it's smooth sailing. Yes, Oscar.
Yeah, I was saying that they said a partnership is considered a resident for a year if any of the partners
It's
resided in Ghana.
That resided is telling you should be resident. You see, tax, you do not take the English as is, as normal English. This resided is not stayed, just stayed, but we are talking about he being resident.
Okay.
So if any of the partners was resident, it means that it is considered a resident partnership. Okay. Because definitely that partnership, we do not tax it in Ghana. It is the individual partners that we tax. Ghanaian law does not have rules for taxing. Okay, there are rules for dealing with partnership businesses, but at the end of the day, we tax the individual partners and not the partnership. Just that the normal rules apply. We'll get chargeable income of the partnership, all right, but we'll share it among the partners in their profit and loss sharing ratio. We'll come and do this later, and then we'll distribute it and then tax them using the graduated rates because they are individuals. Do you understand?
Yes, please.
Okay. So are we okay with partnerships? Can we go to resident trust and company?
So with a partnership, assuming two non-resident persons form a partnership outside, form a non-resident partnership. But during the year, one of the partners resides in Ghana for more than 130.
So it becomes a resident partnership now, meaning that tiebreaker rule will apply to those individuals because they have income from Ghana and income from another country. Do you get it?
Okay, one partner is here, the other will be there.
So it is the partner here who we will base on and say that this then becomes a resident partnership, and then it will start filing taxes, claiming withholding, just like a Ghanaian partnership, right? But anytime there's a foreign tax credit or any withholding tax, it will be shared among the partners in their profit and loss sharing ratio, and then they can claim the credit in such manner.
Okay.
Yes. And this thing I'm teaching is not just for it's very practical. It's only a few people who actually know how to deal with partnership, but they always forget it. So the tax planning, they don't do it properly. So you look at the assessment, you say, these guys are giving GRA a lot of money. But anything,
so okay, if there's a tax credit to this partnership, is it going to be shared among the other partner, the non-resident one, and the one in the country who has stayed here for more than the 183 days.
Yes, of course, because now the partnership has become a resident partnership. So you have to share for the partners in the profit and loss sharing ratio. Because so far as any of the partners was resident, it creates what? I get it. It creates that. Yes.
All right.
So we are almost done with today's session. We have seen resident partnership. Let's look at a trust. Now, when it comes to a trust is only what? Resident in Ghana if the trust itself was established under the Ghanaian tax laws, okay, the Ghanaian laws, and then the trustee. So a trustee is simply a director of the trust, somebody who holds in trust the properties of someone, right? He's a trustee. Just like companies, the directors hold in trust the properties of the shareholders. A trustee is just the director of the trust. So if a trust is established in Ghana and a director was resident in Ghana during the year, remember, the director is an individual, right? So the same rules of individual applies to that guy. Either he was a non-resident but stayed 183 days, so he's a citizen of Ghana, right? That is the rule. So anytime you see it's resident, resided, they are talking, so far as it relates to an individual, apply the rules of individual to that person. So if the trust is established in Ghana, one, a trustee of the trust also was resident at any time during the year, or a person who is resident in Ghana directs or may direct the senior managerial decisions. And senior managerial decisions here has a lot of things, right? Meaning we are talking about operations, how to do operations of the trust, which machines are running, where they do their meetings, where they do their board meetings. You look at all those things, right? At any time during the year, whether you do it alone or you do it with other persons, or you do it through other entities. And this one was created because of what we call step transactions. So you can see a trust which has another trust in Mauritius. That trust invested in another company in Dubai. And Dubai, they went through to buy another trust, came through. So these things, before they were drafting it, they considered what other people were doing, right? So that to some extent, there's a little bit of anti-avoidance in everything that has been captured, so that we do not lose money to base erosion. Okay, I hope that is okay. So first of all, the trust should be established in Ghana. A trustee of the trust must be resident at any time during the year, or you have somebody who is resident, who is directing the senior managerial affairs or decisions of that trust. Then it becomes a resident trust. For a company, it's simple. You must be incorporated under our Companies Act, or management and control of the affairs should be exercised in Ghana. So even if a company is not established in Ghana, the management and control of the affairs of the company are exercised in Ghana. What does that mean? It means that maybe they have a plant here, right, which produces. Who gives a directive to that plant to be operated? How many goods are being promoted? Which director stays to control that? Where is your headquarters? Where do your board members meet? Where do you keep your accounting books? Where do you keep your shareholders' records? All these things talk about management and control. In our double taxation agreement, we call that the place of effective management, right? And this whole principle, you see this section small like that in the section 104, it's actually a big thing when we are considering residence on a general scale. Are we okay? So basically, that is the end of today's session. I thought that when you understand the principle, the basic principles, you see, and it is these basic principles that go into the determination of assessable income and chargeable income, right? So subsequently, in our next session, which I don't know when that is, but when we meet in our next session, what we'll be doing is that we are going to be diving into what? Withholding taxes, because we said what? You have two types of what? Ways you pay taxes in Ghana. Either you have chargeable income or you have what? What did I say? I said anytime you have
withholding payment.
Yes. So we are going to learn how to deal with withholding payment, everything about withholding payment. Then we are going to learn how to deal with everything around chargeable income for all types of entities. So proprietors, partnership, trust, charities, friendly societies, building societies, retirement funds, insurance companies, banks, petroleum entities, mining entities, and individuals who have incomplete records. Okay, so you should be fully fit to deal with anything income tax before we start with indirect taxes. So basically, in our next meeting, we'll finish up with chargeable income, withholding taxes. Then we'll deal with allowable deductions, all the types of allowable deductions, including the new ones and amendments. Then we start solving questions. We must solve at least 3 strong questions around that area, very strong ones which can confuse students. Then we move to the taxation of companies, individuals, trusts, banks, insurance, and the rest. Okay, so within the first month, we should be done with all that. Okay, so I think that brings us to the end of our session. I hope it was not a bad one. And then I hope to see you in the next session. Those who have not registered, you can kindly contact admin or contact me, send me a message, and I'll reply you. And then we take it from there. May the Lord be with you and have a blessed evening and a good night.
Thank you very much, sir.
Thank you and good night too.
Good night.